Hello traders, welcome back to the Forex gig where we dive deep into the tool that can help you make smarter trading decisions. And in today's video, we're going to be talking about the RSI day trading strategy, a technical approach that many traders use to identify potential market reversals and momentum shifts. So why not stay with me until the end of this video to learn exactly how to implement this strategy in your daily trading routine and improve your entries and exit timing. We start by understanding what the RSI day trading strategy is. The RSI simply means your relative strength index, commonly known as your RSI. It is a momentum oscillator that measures the speed and magnitude of price movement on a scale from 0 to 100. And this is the indicator on my screen. Now, this indicator works by calculating the ratio of average gains to average losses over a specific period. Now, when the RSI reading goes above 70, once it goes above 70, this is a 70-hour mark at this area, it signals the market is considered to be overbought, suggesting a possible downward reversal. Conversely, when the RSI falls below 30, this 30 region at this area, once it falls below 30, we are looking at the market to be oversold, indicating a potential upward reversal. So for day trading specifically, you need a default setting of 14. Use a default setting of 14. It works best for many trades, particularly swing trading, who place multiple orders within a day. However, you can adjust this time frame based on your trading style. So for short-term intraday trading, you can make use of your 10, your 9, 11 periods for increased sensitivity to price changes, while long-term position traders might want to use 20 to 30 period for your RSI. Now, during an uptrend, there is a future. The RSI indicator during an uptrend typically remains above 50, while in a downtrend, they stay below 50. Now, the 50 is a center line which acts as a dividing line between the bullish and the bearish territories. So two key RSI patterns you should look out for, or you should watch out for, are the trend lines and the divergence. The RSI trend lines are formed by connecting three or more highs or lows on the RSI line. Very easy, you just look at the trend line. This is an example of the trend line, two or more lows on your RSI trend line. So when this trend line breaks, they often signals potential continuation or reversal of the current trend, while divergence occur when price move does not align with the RSI reading. For example, when price makes a higher high but your RSI makes a lower high. Let's see a particular example. As you can see in this area, if you can look at this chart, you can see this high is higher than this high. Price made a higher high at this area. You can see it, there is a higher high at this area, but on the indicator we can see that price made a lower high. This is a typical example of what we call divergence. So research indicates that shorter time frame generally works best for RSI strategies on stocks, and with 2 to 6 days setting shows particularly strong results. So let's see how we can apply our RSI day trading strategy. First of all, we implement the RSI day trading strategy effectively. It requires a systematic approach that combines technical analysis with disciplined execution. This strategy works best when you follow a set of rules for entries, exits, and management of risks. The overbought and oversold RSI strategy is one of the most reliable approach for day traders. This method capitalizes on market extremes when prices have moved too far in one direction and are likely to reverse. When the RSI falls below 30, it indicates an oversold condition, suggesting potential buying opportunities. Like in this area, we can see that price fell below 30 in this area, which signifies an oversold condition. So if you are to take a trade at this area, because of that, you can capitalize on the reversal to the upside. Now, conversely, in a short position, when the RSI is trading above the 70 region, this signifies an overbought condition and you would have to look for selling opportunities to the downside. Remember, for this example, when we see that the price is above 70, when you are entering your trade, maybe after your candlestick pattern, you see your candlestick confirmation pattern, you will enter a short position. Your stop loss should be slightly above your swing high, to give the trade some room. Your recent swing high that developed when the RSI was overbought, so it has to be this swing high where the RSI indicated is overbought. While for a long position, you would enter your trade when you have spotted your oversold condition and you see your candlestick pattern, then you place your stop loss just below the recent swing low. Stop loss should be just below your recent swing low, the area where your indicator showed the oversold region. The exit strategy for this approach often use multiple options. You can take profit when the RSI crosses the center line at 50, indicating a return to a neutral position. So when you notice the RSI is about reaching the 50 region, this is your 50 line, at this area you can exit your trade. So you are exiting your trade at 1:1 at this area. While in this selling scenario, you can exit your trade at this area when price has gotten to your 50% region. You can also exit your trade with a fixed risk to reward of 1:2 or 1:3 as the case may be. You can also hold your trade until the RSI gets to the opposite level. Since we bought at this area when it was in an oversold region, we can hold it till it gets to an overbought condition. This will give us a stronger and a better risk to reward ratio in this case. Adding a layer of confirmation improves the strategy. You look for supporting evidence from candlestick pattern. So if you want to enter, you can look for your candlestick pattern like your engulfing candle, your pin bar, your morning star, your hammer, your inverse hammer. You can use this as candlestick confirmation to enter your trade. For a bullish pattern, you can use a hammer candlestick pattern. You can use a bullish engulfing for this entry. You use this pattern when you spot your oversold level. When you see your oversold level, you look for this pattern on your chart. Then for in a bearish condition, you look for a pattern at your overbought area. Your overbought RSI levels, you look for your shooting star, your bearish engulfing, and so on and so forth. These are the candlestick pattern you should look for at your area where your RSI shows its overbought condition or oversold condition in terms of a buy and sell trade. The market contents matter significantly when applying this strategy. During strong trends, traditional overbought and oversold regions may need adjustment. So in an uptrend, the RSI typically stays between 40 and 70, rarely drops below 30. That's in a strong trend. While in a downtrend, it remains between 30 and 60, solemnly exceeding 70. Adapting your threshold levels to the prevailing trend improves your signal quality. So remember, in a strong market condition, in a strong trend, this is an example of a strong trend when the market is trending to the upside in a swift move. These are examples when the market is trending to the upward direction in a swift move. This is where you would want to capitalize on using the 40 to 70 region in an uptrend, while in a downtrend you look at your 30 to 60 level. Alright traders, we have come to the end of this video. Engage with us in the comments below. We want to hear about your experiences. If you found this video helpful, do not forget to like, subscribe and turn on your notification bell so that you wouldn't miss out on more trading tips and strategies. Thank you for watching, and I will see you in the next video.